I think the economic recovery is evident in actually all the sectors. So I appreciate the fact that you correctly pointed out that while sectors like metals and cement have done better, have done well at the top line and bottom line level, correctly pointed out that sectors like auto are struggling at the profitability level. But even there, the top line recovery, which is the main indication of an economic recovery, is evident all across. The difference is that sectors which are manufacturing oriented, auto, FMCG, consumer durables, obviously the input cost pressures are coming through. And this is true across the world. I've been saying for the last 9-10 months that because of the breakneck pace of the global economic recovery and the strong recovery in our country, demand is outstripping supply across the world and in India. Demand is outstripping supply for everything from semiconductors to shipping containers to truck drivers. As demand outstrips supply, you have inflationary conditions, and that is hitting the operating margins of manufacturing-oriented countries. But is the economic recovery evident in the results? Absolutely, they are, and I think that will continue. You have a global environment flush with cash. As you rightly mentioned, the COVID unlock is also kicking in. So I think that the pattern for the year ahead has been set. Top line growth will be abundantly available for all sectors. What will separate the men from the boys, the women from the girls, is the ability of companies to protect their bottom line from what is an incredibly strong inflationary environment. I think this is familiar territory for India. So India saw a very similar boom. The 2004, 5, 6, 7 boom was very similar, where the economy was roaring. Inflation was coming through, and input cost inflation and labor cost inflation was coming through. So if you say, look at a sector like IT services, even a large company like Cognizant is saying that it's becoming impossible to get the number of programmers and software engineers you need. So we're living through the strongest demand environment in many sectors that I've seen in, say, 20 years, right? And what history shows us is across sectors, this is when the sector leaders pull away, right? So if you sort of take quality stocks are the sector leading stocks, say, for example, Pidilite, Asian Paints, HDFC Bank, Bajaj Finance, sector leading stocks show operating margin robustness in such a climate, whereas the rest of the market sees operating margin contraction. And that's why the next 3 quarters of this fiscal you'll see a widening gap in share price performance between the broader market and sector leaders. I reckon the sector leaders pull away because their operating margins hold up as they pass on the input cost pressures to their customer base, whereas the rest of the sector will necessarily have to sacrifice operating margin because they won't have that sort of pricing power. So we've seen this before in India, and the Indian data over the last 20 years clearly shows that when CPI inflation goes above 6%, you get sharp polarization in corporate performance as market-leading franchises, and I confess we own these in our portfolios, and Asian Paints, Pidilite, and HDFC Bank, Kotak Bank, Bajaj Finance, they pull away from the rest of the pack, courtesy their pricing power. But I think it's you're absolutely right. IT sector is seeing an insane shortage of software engineers and programmers. You're looking at each of the top four IT companies, I think, will hire lakhs of programmers this year. That's the sort of demand requirement they have, and the indications we have from the Western Fortune 500 companies is the next 4 years. Forget the next 12 months. The next 4 years of order book for Indian IT services is just flowing with excess. That's the amount of visibility they have on digitization work that they'll do for the Fortune 500. But similar problems, say, with truck drivers. I think we already have a shortage of truck drivers. We're not even properly into the economic recovery, and we are hearing about truck driver shortage. My reckoning is by December, we'll start hearing about factory workers, skilled factory workers being in shortage. And what happens in such a climate is you need to be, say, using the example of IT, you need to be a TCS. A TCS trains something like 2 lakh workers a year. I think it's one of the world's largest training programs, fresh training and retraining of 2 lakh IT workers a year. That's the sort of strength you need in your HR and your training programs to be able to flourish in such a climate. And as you can imagine, there'll be no more than, I think, 3 or 4 IT services companies in our country which have training programs which can operate at that scale. Probably TCS, Infosys, perhaps one other Indian IT services companies. The rest of the IT pack will get work. They'll get lots of work, but they'll give up a lot of their top line benefits as they have to give hefty pay rises to their workers in order to keep the talent from running out of the door. So I think no surprises here, Ruchi, because remember the COVID second wave hit the economy really hard in April, up to around say 25th May. So for 2/3 of the first quarter, the economy really was struggling, and I think all of us felt it. I mean, unfortunately, many of us felt it in our personal lives as well. The extent of the second wave hit. But across the financial services space, the commentary has been that debt collection has normalized through July, through August. And therefore, my reckoning is second quarter results pretty much across the board. The second quarter results will be solid, given that the economy seems to have picked up quite nicely as the second wave ebbed away through June. Every indication that we have is the debt collections have fully normalized pretty much across the country through July, August. So second quarter should be fine across the board. The question then becomes the more cautious lenders, the more prudent lenders who provisioned aggressively for COVID, who set aside lots of money for COVID, could they give you some provisioning releases? Could they return some of the provisioning back to the shareholders, so to speak? And my reckoning is that there's a good chance of that. So I reckon by Christmas or just in the quarter ending December, we will get good news that some of the higher quality lenders, Marcellus investee firms such as Kotak, HDFC Bank, Bajaj Finance, are optimistic that we will hear about them saying that they're overprovided and they'll start releasing some of the NPAs, some of the provisions back to shareholders through higher profits in the second half of the fiscal. But debt collections seem to have normalized pretty much across the board for all lenders through July, August.